This trade on NVIDIA was taken using only two things: support and resistance plus volume. It is a textbook example of how identifying institutional footprints can lead to high-probability entries. Forget about RSI, forget about MACD, and forget about 10 useless indicators. In the next several minutes, I will show you exactly how to apply this professional strategy step by step. We will cover entry, stop loss, and targets with a minimum 1-to-2 risk-reward ratio. Let's start right now. The first module is about the correct filter. This strategy does not work on every single stock you see. To be successful, you must learn to be incredibly selective. We only trade stocks with high daily volume and decent volatility. High volume signifies institutional participation, providing the liquidity we need. Volatility ensures enough price movement to reach our targets. We focus on the first 90 minutes after the market opens, the golden window of opportunity. Open Apple on the 1-hour chart and look for these volume footprints. If the volume isn't there, the institutions aren't there, and if they aren't there, we aren't there either. Proper filtering is the absolute foundation of professional trading. Step 1. Mark your zones on the higher time frame. We use the 1-hour chart to identify where the big players are buying and selling. Look for clear support and resistance levels where the price has reacted strongly at least twice. Remember, these are zones, not perfect lines. They represent areas of institutional supply and demand. The market reacts within a price area, not a specific cent. Drawing areas instead of lines helps you avoid noise and gives your trade room to breathe. Keep your charts clean and focused. Mark no more than 3 or 4 major zones. A clean chart leads to a clean mind and precise execution. These zones are your roadmap for the trading day. Step 2. Drop down to the 5-minute chart for execution. We've established our roadmap, and now we wait. Patience is your most profitable skill. We do not enter just because the price touched our zone. Touching the level is merely an alert. We must wait to see how the market reacts. This is where volume becomes our ultimate truth teller. It tells us if there is real money behind a bounce or if it's just a weak trap. Professional trading is 90% waiting and 10% execution. Let the trade come to you, verify it, and only then act. This is how you avoid noise. Let's examine a perfect long setup on NVIDIA. Notice how the price reaches our support zone and leaves a long rejection wick. This long lower shadow shows that buyers are aggressively protecting this price level. Next, we wait for a clear bullish candle to close above the support. But the final confirmation is volume. Check the volume indicator. A bright green spike confirms that institutional buyers are entering. This is your green light. Enter the trade after the candle closes. Place your stop loss safely below the support zone and aim for the next resistance or at least a 1-to-2 risk-reward ratio. This disciplined structure ensures your wins outweigh your losses over time. High volume buying at support is one of the most reliable setups in the market. Now for the short setup. The price reaches our resistance zone on Apple. We look for the exact opposite, a strong top wick and a clear bearish candle closing down. This indicates that supply is overwhelming demand. The volume indicator must confirm this rejection. We want to see significant spikes on the red candles as they pull away from resistance. This aggressive selling volume tells us big players are liquidating or shorting. Notice how volume decreases on weak bounces. That's your secondary confirmation. Enter after the bearish candle closes, stop above resistance, and target the previous major support. Join the selling flow with volume confirmation. The advanced setup. Breakout and retest. Most amateurs lose money chasing the initial big move. To trade this like a pro, wait for a high volume breakout, but don't enter yet. We need to see the price return to the broken level and prove it has flipped from resistance into support. The key is the volume on the pullback. It must be low, showing no selling pressure. When the price touches the old level and bounces with increasing volume, that is your entry. This confirmation ensures you are trading with the real trend and avoids the traps that catch those who chase. Patience on the retest builds consistent wealth. Let the market prove itself. How do you avoid the dreaded fake breakout? The first warning sign is always low volume. If the price breaks a major level, but volume remains below average, the move is suspect. It is often a trap set by institutions to provide liquidity for a reversal. A real breakout has follow-through and aggressive institutional participation, which always shows up in the volume bars. Make this your golden rule. Volume must confirm every single breakout. If you don't see that spike, you don't take the trade. This discipline will save your account from thousands in losses. True institutional strength speaks through volume. If the big money isn't there, stay away. None of this matters without strict risk management. You could have the best strategy in the world, but without a plan to manage your capital, you will eventually blow your account. Risk a maximum of 1% of your account per trade. This ensures you can stay in the game long enough to let the probabilities work in your favor. Understand the math. With a 1-to-2 risk-reward ratio, you only need to be right 40% of the time to be profitable. You don't need to win every time. You just need to ensure your wins are significantly larger than your losses. Discipline is your greatest asset. Never move your stop loss or average down on a losing trade. Trading is a business, and risk management is your insurance policy. Treat it with the respect it deserves. Before you hit the trade button, go through this final checklist every single time. Ask yourself, am I in a clear 1-hour zone? Do I have price action rejection on the 5-minute chart? Does the volume confirm the move? And is my risk-reward ratio at least 1-to-2? If any answer is no, you stay out. Professional traders think and act with this level of discipline every day. This checklist is your shield against emotional errors and market noise. Verify everything before you commit your capital. This is how you build a consistent and sustainable trading career. Let's wrap up with the final conclusion. Support and resistance tell you where to pay attention, and volume tells you if the move is real. Together, they provide you with high-probability locations and truth-based confirmations. Master these footprints, and you master the market. In the next video, I will show you a complete daily trading plan for S&P 500 stocks using this exact strategy. Make sure to subscribe so you don't miss it. Take these rules, practice them on a demo account, and I will see you in the next masterclass. Good luck and good trading. The path to mastery is long, but the rewards are life-changing. Focus on the process, and the results will follow.